Rob, let me ask you this. One of the things that you actually mentioned was instead of going out and purchasing those existing assets to go out and actually ground up and build from scratch. Because I am hearing that, I'm seeing that it's something that Tom has been doing. I've been doing it from buying single family homes. I certainly think it's a lot easier to go out and buy something new than take an existing property and not knowing what you're getting into. So I just like, to having controlled costs. But on your level, on your scale and what you guys have been doing, because last year BV Capital had several investment opportunities to where you purchased existing assets. You did a working class C property for the Sierra Vista deal. You had the student housing portfolio, which I think was a newer building, but you probably still had some value add there, maybe some mismanagement opportunities. So there might be some opportunities like that. Is it correct to say that you're more interested in the ground up development because just the valuations just make more sense and you're willing to hold off on that preferred return for investors for perhaps a larger multiple?
Yeah, the market changed. And so, for 10 years, you would buy a B minus, B plus, A minus property, renovate it, grow your NOI and sell it for a lot of money, and everybody loved it. And the beauty of that is you can make quarterly distributions to your investors along the way, and everybody loves getting that constant reinforcement that they made a good decision, right? The problem is, though you used to make ballpark 18 to 22% return figures on that as an investor, project level is probably a couple points higher. You can't do that anymore. Unless you go way out to tertiary markets, or if you're going to do workforce housing and you're going to deal with a C-class property, it's really hard. There's some nuggets out there, but it's really hard. Another thing that's happening, though, is the massive uptick in DST properties. So don't think that that's not changing anything. So I'm going to step back a little bit on you, Mitch. 20 years ago, it's been 20 years, believe it or not, Robert Kiyosaki came out with Rich Dad Poor Dad. And most people have all read that book, and they all went out and bought 1 million rental homes. Right? And now what we're seeing with the baby boomers getting to retirement age is they're selling all of these rental homes because they don't want the phone call in the middle of the night about a toilet breaking. And so they're moving from active to passive. By doing that, they're selling these rental houses and they're moving into their 1031 exchanging into a DST. DSTs, Delaware Statutory Trust, which is a fractional 1031. These are the funds that people are selling. They have 4 times the demand than they have supply. So what's happening is these larger shops are scooping up everything they can find because they know they're going to sell it in a DST in 3 days. You have this effect that's driving up the valuations of all of this. And so the rest of, and this was new, this is just within the last, call it 3 or 4 years, it's been skyrocketing.
Well, Robin, that's why you're seeing, I was trying to buy a rental, a new one up in Killeen. Not a great market. It's a strong rental market for Fort Hood. List was 200 grand, selling for 250, 260. In a pretty shoddy market and cash offers left and right. Now there's companies that are intermediaries helping that happen, but to your point, I think the DSTs are gobbling these properties up left and right.
They are, and there's single family rental DSTs, which is really unique and it's a new thing. But on the multifamily side, they have bid everything up. So when people talk about the institutions coming into the market, that's where a lot of this is. And I know this because we have these DST sponsors calling us weekly, if not more often. You have product, you want to sell something, it's getting annoying. So kind of like when you get those text messages on your phone trying to get you to sell a house that you don't own, happens all the time.
Nancy Pelosi, leave me alone. I get a daily text from Nancy Pelosi. I'm like, what are you doing?
Well, and Blackstone just bought a huge company that does single family stuff, if you look at that. So you're going to see more and more of it because only 2% of single family rentals are institutionally owned. And the institutions see this and they're going to pour into this in a big way. I'm trying to remember your initial question there, Mitch, because we got a little off topic there, but I think it had to do with ground up. So we absolutely shifted to ground up because the returns are so much better. Now, as an investor, you don't get paid to the end, but when you get paid, you hit the lottery. It's kind of what it feels like because we're talking 2 to 3 times on your money. And here's the cool thing. It can be as quick as 3 years because depending on what kind of product you're building in the apartment space, if it's garden versus wrap means apartment garage wrapped with units, higher end density, but then you got a higher exit. Those take about 3.5 to 4 years, but a garden you can do in 2.5 to 3 years. Yep. And you can still have a 2 to 3x potentially on your exit. Find that elsewhere.
Yeah, and go back to the existing structures, right? You're at a 5% cap. You think about what a 10-year going to 3% means, right? Like your debt structure matters a lot more in these existing syndications than it does in it still matters.
Exactly, Tom. So Tom, a lot of folks we look at everybody's PPMs that are out there, and you got to watch. Remember, I said you got to watch the debt. A lot of these people are doing interest-only variable rates through construction or through renovation. What happens if the Fed does go point? How does that affect your model? Is that built in? Another trick that we see other people doing is they're betting on a refinance to cash people out early, and because an IRR is time weighted. So the sooner you give people the money back, the higher that IRR looks. It's a complete trick, and it throws people off. I prefer the equity multiple. If I give you $1, what are you giving me back? Just if people are looking, trying to figure out what to do and how to understand this stuff, it's just a little kind of a cautionary thing. You got to look at that. If there's a refinance in that model, I'd probably step back and say, well, what if that refinance is not the way you think it is? How do the numbers look?